All right, so startup fundraising, right? We always hear about the big successes, the valuations skyrocketing the headlines, but what about the stuff nobody talks about? Like what really happens behind the scenes?
Yeah, the reality is often way different than the flashy stories you see.
Exactly. So today we're kind of going behind the curtain,
Yeah.
doing a deep dive into the nitty-gritty of what it takes to actually raise money for a startup.
Think of it like startup fundraising, Mythbusters edition.
Exactly. And our source material for this deep dive is this great article called Startup Fundraising, Challenges and Realities.
Really good stuff.
Yeah, it's like a reality check for anyone thinking about seeking funding or just curious about the venture capital world.
Right, so if you're in that bootstrapping.
So first up, one of the biggest myths we got to bust is that just having a killer idea automatically means you'll get funding.
The illusion of easy money, it's so tempting to believe that.
Challenge number one, right? Like you come up with this brilliant idea and you think investors are going to be throwing money at you.
Oh, yeah, but investors are a lot savvier than that.
They are. They want to see more than just a cool concept, right? They want proof.
They want to know it's viable.
Totally.
Yeah.
And the article brings up Airbnb as a great example.
Oh, yeah, they're huge now, but
But in the beginning, they got rejected by a ton of investors.
it's true. They even had to sell cereal to keep the lights on.
Can you imagine? Selling cereal to fund your billion-dollar company.
Wild, right?
So clearly just a good idea isn't enough.
No. You have to convince those investors that your idea is actually going to work.
Yeah, show them the money.
So true. And that leads us right into challenge number 2. This catch-22 of traction versus funding.
Yeah, the classic problem. Investors want to see that you're already successful.
But you need money to get to that point.
Exactly.
Yeah.
It's like you need experience to get a job, but you need a job to get experience.
It's a tricky cycle for sure.
The article talks about WhatsApp struggling early on because their model didn't really fit traditional advertising revenue.
Yeah, they had to really prove their value proposition.
It wasn't until their user base blew up that those big investors like Sequoia Capital came knocking.
Exactly.
So how do you even break out of that catch-22?
Well, one thing is to really nail down that value proposition. Make it crystal clear, even if you don't have a ton of users yet.
So showcase that potential right away.
Right. Like WhatsApp, even without ads, the value they brought in connecting people was obvious.
Makes sense.
Another thing to consider is exploring alternative funding options early on.
Like grants or angel investors.
Yeah, or even bootstrapping, getting creative with how you fund those early stages so you can gain some traction before going after those big VC firms.
So no one-size-fits-all solution.
Not at all. Each startup's journey is unique.
For sure. And speaking of journeys, let's talk about the emotional side of all this, because fundraising isn't just about numbers and spreadsheets.
Yeah, that emotional roller coaster can be intense.
Challenge number 3, the emotional roller coaster of fundraising.
Imagine constantly pitching your heart out, believing in your vision.
Only to get rejected over and over again.
It takes a toll for sure.
The article mentions Howard Schultz, the founder of Starbucks.
Oh, yeah.
He got rejected over 200 times before finally securing funding.
That's insane.
I know. It's inspiring, but also kind of brutal.
Makes you wonder how founders stay motivated through all that rejection.
Right. It's easy to say, be persistent, but actually doing it when you're facing constant no's, that's got to be tough.
It really is. So having a strong support system is crucial.
Like mentors other entrepreneurs.
Exactly. People who get it, and even therapists. Taking care of your mental health throughout this whole process is huge.
Because this isn't just a business challenge, it's an emotional one too.
Absolutely. And I think it's also about reframing rejection as a learning opportunity.
Oh, okay.
Instead of seeing those no's as defeats, see them as chances to improve your pitch, to understand what investors are looking for.
Fuel for the fire.
Exactly.
Right.
And at the end of the day, remember, fundraising is a marathon, not a sprint.
Pace yourself. Learn from each experience and never lose sight of your vision.
Couldn't have said it better myself.
Now let's switch gears a bit and talk about something that often gets overlooked.
Okay.
The power dynamics in investor meetings.
Ah, yes. That can be a tricky landscape.
Challenge number 4. The article talks about this inherent imbalance, right? The investor has the money, and that creates a certain dynamic.
It's a negotiation, and sometimes it can feel like the playing field isn't exactly level.
Especially for first-time founders.
For sure. The article mentions Evan Spiegel, the founder of Snapchat, turning down a $3 billion acquisition offer from Facebook.
Talk about bold. But what about founders who don't have that kind of leverage?
Right. Not everyone can walk away from $1 billion.
Exactly. What are some of the traps they need to watch out for?
Well, one common one is being too eager to please.
Like wanting to make the investor happy so badly that you agree to terms that might not be in the best interest of your company.
Exactly. It's important to know your worth and be willing to walk away from a deal that doesn't feel right.
So don't be afraid to say no.
Exactly. Another pitfall is not fully grasping the terms of the investment, especially when it comes to things like equity dilution and control.
So you got to do your due diligence.
Absolutely. You don't want to give away control of your company without understanding the consequences.
It's about making informed decisions that align with your long-term goals.
Right.
Which brings us to a really important point: the hidden costs of raising money.
Yeah. Everyone focuses on that influx of cash, but there's another side to the coin.
Challenge number 5. And the article really digs into this.
Right. So first up, equity dilution.
Meaning, when you take on investors, you're giving up a portion of ownership in your company.
Exactly. And that can affect decision-making and future profits.
So it's not just about the money come in, it's about who owns what.
Precisely. Another hidden cost is the potential loss of control.
Because those investors, especially ones with significant stakes, they could have a say in how your company is run.
Right. So it becomes a question of, is the funding worth potentially compromising your vision?
It's a trade-off, for sure.
The article uses WeWork as a cautionary tale.
Oh, yeah, that was a wild ride.
The founder, Adam Neumann, ended up losing control of his company when investors stepped in.
It's a reminder that investor relationships can be complicated.
They can. And misaligned interests can lead to some major problems down the road.
So how do you weigh the pros and cons of funding? How do you know if it's the right move for your startup?
That's a big question.
And it's one we're going to tackle in part 2 of this deep dive.
Sounds good.
We'll also be busting the myth of the one big check.
Ah, yes, the magic bullet.
And we'll dig into the realities of those post-funding expectations.
The pressure cooker.
Exactly. Plus, we'll explore alternative paths like bootstrapping.
Can't wait.
So stay tuned for more myth-busting insights into the wild world of startup fundraising. Welcome back to our deep dive. Exploring the real deal when it comes to startup fundraising.
Last time we were talking about all those hidden costs that come with getting that money.
And now we're tackling this big myth that trips up so many founders.
Yeah, the idea that there's this magic one big check out there waiting for them.
Like it's going to solve all their problems. Poof, just like that.
Right. Challenge number 6. The myth of the one big check. It's so tempting to think that one huge investment will just launch you to success.
Yeah, like winning the startup lottery.
But the article makes it clear fundraising is more like, it's a journey.
A marathon, not a sprint.
Exactly. It's not a one-time thing. It's a process.
And it usually takes a lot longer than people think.
The article actually uses Uber as an example. They went through something like 20 funding rounds.
Why? Hell.
Before they finally went public.
That's a lot of pitching, a lot of talking to investors.
It shows you how fundraising changes as a company grows. Each stage has its own challenges and requires different kinds of funding and different types of investors.
So how does that work? Like, how does the process change at different stages?
Well, in those early stages, pre-seed and seed rounds, it's all about getting enough money to build that first version of your product and prove that people actually want it.
The minimum viable product.
Exactly. You're usually looking at smaller investments from angel investors or early stage VCs.
So you got to prove your concept can work in the real world.
Right. Then, as the company starts gaining traction, you move on to later rounds like Series A, Series B, and so on.
And those are bigger investments, right?
Much bigger.
Yeah.
That's when you're looking to fuel expansion, marketing, product development, really scaling up.
I bet the expectations from investors get pretty intense at that point.
Oh, yeah, for sure. And that actually leads us right into challenge number 7, the reality of post-funding expectations.
You finally get the money, but then the pressure kicks in.
It's like you're in a pressure cooker. Suddenly you have to deliver.
The article talks about Quibi. Remember them?
Yeah, they raised a ton of money, but they just couldn't make it work.
They grew too fast, and it wasn't sustainable.
Right. It's a good reminder that growth has to be strategic. You can't just throw money at a problem and expect it to magically solve itself.
So how do you balance those investor expectations with staying true to your vision? Like, how do you make everyone happy while still building the company you want to build?
Well, communication is key. Being transparent with your investors about your progress and your challenges.
So keeping them in the loop.
Exactly. And setting realistic milestones that make sense for your company.
And remembering that investors can actually be helpful.
They can. They have experience. They've seen a lot of companies succeed and fail, so their advice can be really valuable.
It's about building those relationships based on trust and open dialogue.
Right. Now, before we wrap up, it's important to remember that venture capital isn't the only way to build a successful company.
True. There are other paths, and the article highlights one in particular, bootstrapping.
Ah, yes, the good old-fashioned way.
They use MailChimp as an example, a billion-dollar company built without any VC funding.
Pretty impressive, right?
It is. It shows you that you can create a profitable, sustainable business on your own terms.
So when does bootstrapping make more sense than going the VC route?
What are the things founders should be thinking about?
Well, it's a good option if you don't need a lot of capital up front. If you can get started with your own savings or maybe some loans from friends and family.
So it's about how much money you need to get going.
Right. Also, it's a good fit if you're really passionate about retaining equity and control, being the one calling the shots.
If you want to stay in the driver's seat.
Exactly. And if you're comfortable with a slower, more organic growth trajectory.
It's about matching your funding strategy to your personal risk tolerance and your long-term vision for the company.
Precisely. Making choices that support your unique entrepreneurial journey.
So we've covered a lot of ground in this deep dive, from debunking those common myths to exploring the real challenges to considering different paths like bootstrapping.
It's all about giving you a realistic view of what startup fundraising is really like.
And hopefully arming you with the knowledge you need to make smart decisions.
Whether you decide to go the VC route or bootstrap your way to success.
We're here to support you every step of the way. And we're back for the final part of our deep dive into startup fundraising.
We've talked about the challenges, the myths, the realities.
Yeah, it's been quite a journey.
It has. But before we wrap up, I think it's important to bring all this back to you, the listener.
Right, because all this information, it's only useful if you can actually apply it to your own life.
Exactly. So let's get practical for a minute. Imagine you're a founder, you've got this amazing startup idea, you're passionate about it, you're ready to go.
You got the drive, the vision, the whole package.
But now you're facing that big decision to fundraise or not to fundraise.
It's a crossroads, isn't it?
It is, and it's a decision that can really make or break your company.
So knowing what we've talked about today, what are the things you'd be weighing? What would be the most important factors in your decision?
Well, I think one big question is, would you be willing to give up some control in exchange for the potential of faster growth?
Right, because taking on investors means giving up some of that ownership.
Exactly, and it also means dealing with those expectations, the pressure to deliver.
And are you prepared for the emotional roller coaster that comes with fundraising?
The pitching, the rejection, it can be tough.
It can. Or maybe you'd prefer to bootstrap, build your company slowly and steadily without having to answer to anyone.
It's about finding the path that aligns with your values, your goals, your risk tolerance.
There's no right or wrong answer here. It's about what's right for you in your company.
Exactly. You might be the next MailChimp, proving that you can build a billion-dollar business without any VC money.
Or you might decide to dive into the world of venture capital and use that funding to build something truly game-changing.
Whatever you choose, we're here cheering you on.
So keep learning, keep hustling, and most importantly, never give up on your dreams.
That wraps up our deep dive into the world of startup fundraising.
Hopefully you found it insightful and maybe even a little inspiring.
If you did, we'd love to hear from you. Head over to social media and let us know what you're thinking.
And until next time, stay curious and keep innovating.